Hey everybody, welcome back to another beautiful day in real estate. Today we're going to be diving into oil prices. We're going to be talking about the Strait of Hormuz. We're going to be talking about the last day of the ceasefire. And we're going to be talking a little bit about the economic perspective and what the outlook is going to be for the next few months. Without further ado, let's jump into oil prices. Mortgage rates are relatively untouched today. Again, everything's been kind of steady. It's the last day of the ceasefire in Iran. So what are we going to be expecting over the next few days? Well, from an oil's perspective, oil spot, this is WTI crude oil spot trading, not futures. That's always a big distinction. But from a technical perspective, it looks like we're kind of running out of juice for going down. I think most of the sell pressure has kind of hit the bottom. This relatively is a bottom in one way, shape, or form. We saw volatility here, right around the bottom of these two candlesticks. Volatility here, volatility here. But from what it looks like, we're still within a bit of a range where it could bounce up. But the market's relatively unchanged. The market opened about 37 minutes ago, and it hasn't very much moved, right? So again, from a technical perspective, the stochastic's oversold. The RSI is still, relatively low, but it still hasn't broke above that 47, which would be indication that we're in a more of a bullish trend, right? So, we're going to find out today what the market's going to do. We're going to find out because after today, we're going to know, are we still in a ceasefire? And if we are and still in a ceasefire, how long is it going to be? We're going to know a little bit more about, we're going to know where the outlook is for the next few weeks. And I think everybody's just been waiting for that because we need to understand where to put our money. And there's so much uncertainty. I listened to this podcast this morning talking about, it's a real estate podcast, but he was talking about how so many people are uncertain with real estate right now. But to the same notion, there's going to be skeptics in every category, right? And I still believe that real estate is going to be a better investment this year than anything else. And I did talk a little bit about why the S&P is potentially going to have a blow-off top this year. And I'll kind of go a little bit more deep on that in just a jiffy here. But the 10-year bond, you guys, is moving upwards slightly, which is why interest rates, I'm guessing, are probably going to move up a little bit. We're at a pretty solid resistance right now. So today's really going to decide, are we going to go up? Are we going down? Or, I don't think we're going to consolidate. Again, I think it's just the expectation of what's going to happen. So, because basically for the last 6 trading days, it's been relatively the same price. Or same interest rate. This is kind of nuts to see it kind of bounce off of this double top. This was the last double top before it went down, and we're starting to form a resistance here again. So there's a good chance we could head south. I don't think we're going down to 3.97, but there's a good chance that we're going to see a downward pressure in it. So that being said, where are we at with the S&P this morning? The S&P, we woke up. S&P, again, I'm starting to think it's a local top here. Today it just kind of makes a little bit more sense. This gap has to be recovered. I shouldn't say has to, but from a trading perspective, this gap is going to be found once again. Everything's way overbought. And we kind of are seeing a local top, if you will. It might see some downward pressure. Again, it's just waiting for what's going on in Iran, what to expect, and what we're anticipating, right? So we did pull up a quick video with a quick interview with Trump talking about the Strait of Hormuz. So we'll jump into that real quick, and then we will talk about it, okay?
And the blockade has been a tremendous success. They said 2 days ago, we will open the Strait. I said, no, we're not going to open the Strait until we have a final deal. No, we want to open the Strait. They said, we're not opening. We totally control the Strait, just so you understand, for all the fake news out there. And the block.
So they're talking that the Strait of Hormuz, Iran wants to open it up, and President Trump said, absolutely not until we have a full deal, which, doesn't really surprise me. He's kind of he's a bit of a control freak, right? So he's going to control that portion of the war as best he can. And that's why there's a blockade set in place. To me, the nervous thing is how long are you going to play chicken before somebody's going to have to really absorb this? And it did talk about this a little bit in some articles I was reading this morning about how most people are not, or most categories are not absorbing the shock for oil. We did see a massive reserve release from multiple different places, which was up to like 300 million barrels or something like that. I think the United States put 170 million into the pot to have a continuation of flow of oil, right? Because a lot of people are feeling like their countries are running low on supplies, and they don't want to see some sort of gasoline, petrol famine kind of concept, right? Where there's minimal minimal availability. Well, with that being said, this is setting up for next week Tuesday, in my opinion. Next week Tuesday, Kevin Warsh is supposed to be confirmed, excuse me, as the new Fed president. There's been a lot of talks about him not lowering interest rates, which to me doesn't really make much sense. I guess we're speculating, obviously, 100% here, but if Trump's going to put somebody into the Fed president who doesn't want to lower interest rates, that just seems counterintuitive to what he's been saying to Jerome Powell for the last year and a half, right? So, in my opinion, we're going to see a step into that direction of lower interest rates, which means there has to be a war, peace deal where we stop fighting. And I think that could happen in the next couple of days. If we see it, now is going to be the time to see it. If we don't see it now, we're not going to see it for a long time, in my opinion, because we have to factor in logic, right? Because everybody's looking at a news headline, but really we have to factor in what's correlating to the timeline, what's correlating to the story, right? So things get moved in a very strategic way in a lot of cases. And right now, again, we have to factor in that Tuesday is supposed to be the nomination or the confirmation for Kevin Warsh, which after May 15th is supposedly when he's supposed to take over as Fed head president. What's going to happen from there, right? I still think interest rates are going to come down this year. It's going to be towards the back end of this year, and it's going to be moving into midterms, and it's going to be very blatant that the reason they're dropping interest rates is to create more credibility for the Republican right side. To me, that's the only thing that makes sense. Again, I could be missing some factors here, but to me, that's the one thing that does make sense that we're going to see. We're going to see motivation to lower interest rates, create more housing affordability before the midterms. And then after the midterms, I'm not exactly sure what to expect yet. We'll kind of grasp that in a few months once we get closer to it. But right now, I'm going to convert over to real estate. And again, I know there's uncertainty because of this war, which is correlating with interest rates. But you know what I'm starting to realize? Maybe 1 out of 10 people are actually concerned about the interest rate. They're more concerned about the payment and the monthly payment and the valuation of the home. So like I've said in one of my couple of my shorts and my reels is that if you're not working with the right lender, first off, you guys, if you're not working with the right lender and realtor, they should be able to get you to where you want to go. Now, sometimes their expectations are unrealistic, but for a realtor and a lender's perspective, it is to be as creative as possible to get you in the situation that's going to best suit you and your family, you and your wife, you and your boyfriend, girlfriend, whatever it is. But that's our responsibility, right? And right now it's harder to get people into those deals. And for me, it's very important that when we're working with these people that we're guiding them to the right step so that they're not wasting their time, energy, and honestly, their excitement for buying a house, because everybody deserves to be in a house. And there's a way to make it happen in most cases. And you just have to work with the right people to work with the right solutions, right? But that's my little rant for today. So you guys, this has been popping up more and more and more and more. Talking about 43% more sellers and buyers nationally. We're talking about the lowest lowest home sales since 2009. This is where we're kind of, again, I'm going to correlate that we're more towards the bottom of a recession than we are at the beginning. I shouldn't say the bottom of the recession, the correction in the real estate market. So many things point to the opposite of a real estate correction. Again, month of inventory super low compared to where it was in 2009. We're talking foreclosures, extremely different than 2009. We're talking the big thing you have to pay attention to. I rattle off those same things every couple of days, but here's what we need to pay attention to. Right now, most people have equity in their homes and most people have an affordable interest rate. It's not an affordability issue for people that have homes. It's an affordable issue for people trying to buy homes. So when people have that much equity in a home, they're not going to sell unless they have a reason to sell. So ergo, it's freezing the market. It's not crashing the market, right? And most people are not buying a house because it's an affordability issue, right? So we're not in a time where affordability is what's creating foreclosures and potential bankruptcies, et cetera, because we're not leveraged on that side of the market anymore. We're not as leveraged as we were in 2009. If we're going to talk about leverage, we're going to talk about over here, which is the private debt crisis, right? So when it comes to real estate, again, real estate is still very strong in my opinion versus other markets. The bigger things that I would be concerned about is, again, credit card debt. People are spending insane amounts of money on credit cards because they can't afford the daily necessities. There's an article that'll pop up here talking about savings and a little bit of metrics behind that. But Most people are over leveraged in their cars. They brought negative equity over from their cars, and they're paying anywhere from $800 to $1,200 a month for a payment. Most people are so used to going to Starbucks every single morning that they actually, um, I shouldn't say that that's the only thing, but my point is there's bad habits behind it and bad spending habits where people are spending hundreds of extra dollars a month on stuff like food and extra items they don't need. Those are the things that concern me more than real estate does. Most people, the last thing they're going to lose is their housing, right? Because that's where they need to be. They'll let their car get repoed. They might stop going to Starbucks. They might stop getting, going out to eat all the time. But the housing thing, like people don't typically stop paying their payment unless they absolutely can't make it work. And right now, people have equity in their homes. So the thing that we need to do is we need to figure out a way to remove that real estate freeze so that people can take that equity and move into the market, right? So the real estate market's kind of halted right now because most people don't want to sell when they're at a 3.5, 4, even a 4.5% interest rate and jump up to a 6. It just doesn't make sense, right? So the people that are moving right now are people that have to relocation, divorce. They need to get a bigger house for their family. We need a bigger house. We have a kid and we're running out of space here in our little house, so we have to move up, right? That's where real estate becomes more strong to me, and it makes more sense to be buying real estate now than it does to be buying any other asset. Right now, this S&P doesn't make sense why the market's that high. The S&P saw new all-time highs again at the end of last week, moving into the weekend because of the Strait of Hormuz was supposed to be open. But here's the issue that we're seeing now. I'm seeing a lot of money being bought into the market, and I might have an article here to touch on this real quick. Like, yep, right here. Well, not an article, but a headline, I guess. So the Federal Reserve's balance sheet rose by $12 billion week over week to $6.7 trillion. Total assets. So they're basically the government is buying real estate or buying stock assets again, buying assets, right? And that was bottom was right around 2025, end of 2025, when they got rid of quantitative tightening and started going back to quantitative easing. This isn't as significant as pre-COVID and post-COVID when they pushed hundreds of millions and billions of dollars into the market. This is different. This is where I shouldn't say different, but it's a lot less money getting pushed into the economy, right? So at first they were pulling all that money down. We're already almost back to the highs of, May of 2025. So basically a year ago they're buying more assets is the whole point I'm getting at. So they're buying more assets to put on the balance sheet. By buying more assets on the balance sheet, it pushes more liquidity into the market. By pushing more liquidity into the market, gives people the capability to spend more money. The more money people spend, the more the confidence in the economy. Interest rates follow behind that, right? So there is a quiet push to lowering interest rates. It's just printing more money, which is again a temporary. I shouldn't say printing more money, but buying more assets to elevate markets to make them seem strong. Um, right now, there's not a lot of buyers for the bond markets because people again are uncertain about what's happening. It started to trickle up for a time there, and then it kind of fell off a cliff again. The buying pressure. So anyhow, last two things we'll touch on today is the global debt. So this is a big one. This is really a big one for everybody to be paying attention to. The world is heading into a historic debt crisis. The global government debt is projected to surge 102% of GDP by 2031, a level previously seen only in the aftermath of World War II, according to the IMF. World government debt already stands at 94% GDP. Debt to GDP has risen 16% since 2015, with the US and China responsible for the majority of the increase. This comes as the U.S. is running a government deficit of 7 to 8% GDP, with debt projected to rise 142% of GDP by 2031. At the same time, China's debt to GDP is expected to increase to 127 as the country's deficit has widened near the 8% GDP gap, and the global interest payments expected to rise 5% of GDP by 2031 from the former 3% as government refinance mature debt and today's higher borrowing costs. The global economy is increasingly fueled by debt. So the big thing to pull away from that is the entire system across every country across the world is built on debt, okay? Why did the U.S. do so strong for so long? The U.S. did strong for so long because people were using the U.S. dollar as a base currency, right? They were using it to purchase oil. So again, the Strait of Hormuz has more implications than just oil. It has everything to do with money and where it's being spent, right? So my point of reading over that was that pointing out one thing, which is GDP is terrible across the board, meaning that we're basically at 94%, we're basically 6%, 6% below what we're taking in, right? So basically, we're making 6% on the money across the world, but the United States is at 142% GDP. So that means we're losing 40%, 42% more than we're actually taking in right now. That's a concerning thing to be paying attention to, right? Because in any reality, anywhere across any country in any world, if you were 142% GDP ratio, you went into a bank for a loan, they would tell you to kick rocks and get the F out and file for bankruptcy, right? But we can't do that, not with a country, right? Not with the world. So again, implications state that right now global public debt is just getting higher and higher and higher and higher, and eventually, and it's going at an increasing rate. So since 2016 or 2015 here, we've seen significant increase in debt. When there's significant increase in debt, the devaluation of the dollar and different currencies continue. When the devaluation continues to go down at a significant rate, prices of things continue to go up, which makes people feel more and more uncertain about what expectations should look like in the next few years. Now, that being said, this correlates to the next and final thing I'll be talking about. Nearly 40% of Americans have less than $500 in savings. 40%. 40% of Americans do not have more than $500. 14% have nothing at all. And about 45% couldn't cover more than 1 month of expenses if their income stopped. 2/3 have already dipped into their savings just to pay for essentials like food. At the time, the dollar has been weakening, hitting its lowest level since the Iran conflict began. For millions, financial cushion is already gone. So there was a time during COVID when we got all these stimulus checks that everybody had a bunch of money in savings, and there was some of the highest rate of savings that we've ever seen. That has come to an end. People do not have that money anymore, and relatively, it was not that much money anyways. I mean, to some, $1,400 and $1,200 might seem like a lot, but quite frankly, that covers about 20% of my bills in a monthly basis, and that's on a good month. Like, it doesn't cover dick. And the thing is most people had spent their money before they even got it, but that's not here nor there. But that's the repercussions of printing government money like this, because everything gets devaluated. When you push that much money into the economy, you create a lot less valuation behind that currency, right? When we do that, we lead to things like this, where it hasn't been talked about a lot, but the Strait of Hormuz, they said that Iran said the only way that oil could flow through it for a while until most recent was if they paid in cryptocurrencies or the digital yuan. They had to pay in yuan and they had to pay in that currency. For a long, long, long time, since World War II, we've paid for oil, petrol, with the petrodollar, which is the US dollar, which has created that much backing behind it for the last 60 years until most recent. And it's important to pay attention to, because what they're doing is not just cutting off oil supply. They're trying to remove the world from the currency which is dominant, which is the United States dollar, right? The petrodollar. If they remove the petrodollar, it no longer has the valuation behind it. China's making an effort to become the new dominant currency. I don't know if that'll happen. That's a whole nother conversation. But without getting too sidetracked into that conversation as a whole, what we need to be paying attention to is how can we start building wealth right now, because most people are going to be back to that paycheck to paycheck, and they're not going to get away from that. And it's going to be a lot harder. So right now, it's more important than anything to really understand how you can start building wealth. And in order to build wealth, you have to start investing your money. The best way to start investing your money is invest in where you live. When you live in a place that's building equity and you're paying towards something, you're getting way more value than if you're just renting. A lot of us, our younger generation, is convinced that you can't buy a house. That isn't true. Right now I'm seeing a lot of young people rent for $2,000, $3,000 a month. Granted, they have roommates, but why wouldn't you buy a house and then have roommates there where you could build equity? It's like they've convinced the younger generation that you're better off renting and you're better off leasing and you're better off never owning anything because the market could crash. That seems so irrelevant and dangerous, because most of you will not get into a house because you think that it's not worth it. I can tell you from personal experience, in 6 years, we've gained enough equity to put over 25% down on our next home. Again, I understand the monopoly of, it was kind of the anomaly of COVID and the printing of money. But here's what is still important. Bismarck still saw a 6.6% increase on valuations in homes. There is less inventory, there is less buyers out there, and homes still rose 6%. If we see interest rates drop, which is possible this year, if they can get a hold of inflation and bring interest rates down, which again is a highly unlikely situation, but is possible, you have the opportunity to see a significant gain in buying a house and evaluation of your home. That's what's important to be paying attention to. It's important to understand that after everything we go through, that you're putting your money where you can actually see it increase, not just dumping it down the trash can. It's important for us to do that because I feel it's an obligation for me as a real estate agent and as somebody who works in real estate and understands this, that I should be teaching as many people as possible what it means to actually be in real estate. So anyways, with all that being said, thanks for watching. If you made it to the end, like and subscribe for more. Comment if I feel like I went over something or didn't explain it correctly, and we'll dive into it tomorrow. Have a great day.